Welcome to the Greener Way podcast. I'm your host and managing editor of FS Sustainability, Rachel Allen-Backus. In this episode, brought to you by First Sentier Investors, we'll be discussing how environmental, social, and governance issues play in credit strategies. First Sentier Investors Senior Portfolio Manager Global Credit, Craig Morabito, starts by explaining the role of material ESG issues on credit risk assessments.
We monitor every single credit that we have. We assign an internal credit risk assessment to those credits. And ESG integration forms a material part of that overall credit assessment. We create internal ESG ratings and ESG trajectories for those credits. And the impact on that overall credit risk assessment is quite material. For example, when we rate a credit below the market, 60% of the time it's also because they have a high or very high internal ESG risk assessment. And then on the flip side, when we rate a credit higher than the broad market, 30% of the time it's because it has a very low ESG risk assessment attached to that. So that integration into our internal credit risk assessment is quite material. We've been doing it for over a decade. We've learnt a lot, and we really do think that there are quite significant benefits on the risk side. So we do think it provides a level of protection over and above just a fundamental balance sheet credit assessment. I would say opportunistically wise, I think more recently, there have been alpha opportunities from focusing on credits that have good ESG risk profiles or that manage ESG risk well. And I think that has actually played out in the broad capital markets. I'm happy to talk about the sort of different parts of the market, but if you do look at tobacco or fossil fuel credits broadly, they've underperformed the broad market for their stated credit risk. So there are opportunities, and I think, increasingly as, investors more broadly focus on good ESG risk profiles, the weight of money argument will bid prices higher.
That's interesting. And when we're talking about, Craig, let's just be really transparent for the listeners. Are we talking about corporate credit and sovereign credit, or are we talking about predominantly the corporate space?
I predominantly focus on the corporate space. In the credit market, there are government agencies, and their ESG risk profile is very much tied to the sovereign space. And I'm sure many of us in the audience know that sovereign space is really hard to get your head around. The way we are thinking about sovereign ESG risk is very much similar to credits or corporates, in that there's a governance structure as in the politics, and they're binding drivers of what they might do and might not do, and how that changes over time, as well as the outcomes, so that the social or the environmental outcomes of any one policy over time.
Understood. Excellent. So, Craig, are you able to use the tools of being an active owner when it comes to investing in corporate credit? We focus a lot on talking about active ownership, like, voting proxies, which clearly doesn't work in the credit market, but engagement predominantly as well. Do you use engagement as a tool in credit, and where do you intervene in terms of that?
It's a great question. And considering, credit isn't as focused on when it does come to engagement, because we don't have the shareholder voting power. What we do have is the financing power, and corporates raise a lot of their balance sheet funding in debt markets. So there's a lot of power in that. Now, it's fair to say that central banks have provided liquidity to all markets, and therefore funding has been fairly easy to get in the last decade or so. I'm not saying easy, but easier than may have otherwise been the case. Now, that's changing, obviously. The central banks are pulling away the punch bowl, as it were. So that will provide debt investors with a great opportunity when refinancing comes up. And obviously bonds mature. They might have a 3-year or a 5-year, but they do mature. It's a great time to also engage. There's yearly engagements, but this refinancing can really put a bit of pressure, if needed, onto a corporate to enhance their ESG profile if necessary, and focus on anything specific. Development in the debt markets are the sustainable linked bonds or loans.
Mm.
I think that's a great development. I think, having challenging goals is important and having relevant goals is important. And we're at early stages of making sure that that's the case. But the idea really does make sense, because when it does come to that refinancing moment, it's a nice clean structure to be able to put forward to a corporate, hey, this is where I need you to get to for me to provide funding to you right now.
Interesting. And so on that, you're reading my mind, because I did want to ask you about that broad swathe of sustainability linked credit, whether it's, green bonds, sustainability linked bonds, social bonds. Where is the market for that currently? And does this sort of broad swathe of linked issuance on the corporate side, is it deep enough and sort of mature enough to figure strongly in your portfolio strategies, Craig?
I think the answer is yes. In terms of the market's development, as I mentioned, sustainable linked bonds or loans, I still think are at the early stages, and I think that I think more work can be done to set those stronger 5-year type goals or higher objective type goals. Data plays a part in that as well. If you've got 5 to 10 years worth of data, it's a lot easier to sort of set trajectories and have something robust there. We're at the early stage of the data uplift, so that makes it a little bit more challenging to set longer term trajectories, but it's still possible. And there's other factors that you can put into those objectives, and I will say, and I know corporates might find it really upsetting not to achieve an objective, and it will feel that might impact them negatively. But on the flip side, that's where engagement comes in. That's where ongoing discussions come into the play. If you've set an objective and it's quite significant, and it is a stretch objective, and you've got a good strategy that everybody's supporting, and therefore you're getting the funding, that's a positive sign. Now, along the way, just like investments, some, may fail over time, some might succeed. You 2 steps forward, 1 step back type approach. You want to get there in the end. So for mine, that engagement along the way will help, I guess, give the corporates comfort that the broad financing will continue to be there as long as they're doing what's necessary. I mean, I think a great example will be, or what we're seeing in the European market, where the economy is going a little bit poorly at the moment. Earnings are going to take a hit. That might mean that certain capital expenditure plans can't be put in place in the next year, which might mean that shorter term goals might be at risk of not being achieved. But that doesn't mean that in a year or 2 years' time that they can't put in measures to try to overcome that, so that when the refinancing date comes, or when that sustainable objective date is hit, that there won't be any negative market consequences.
So let's turn to a specific facet of ESG and how this plays out in terms of your credit strategies at First Sentier Investors, Craig. Net zero and climate change. Clearly, we're in the critical decade in terms of getting results underway in terms of that adaptation and transition to net zero. We're just about at that point where we're almost at the 7 years out mark, which marks an interesting alignment for future issuance. How do you evaluate net zero, either broad transition of economy, specific goals of companies that have set net zero targets, and how they play into credit strategies, both that that narrow sustainably linked bond space and wider evaluation of mainstream credit?
So we take a 2-pronged approach to net zero in our credit portfolios. The first part is an internal assessment of the net zero alignment of every single corporate. And we use the IIGCC framework, the Institutional Investments Group for Climate Change. And
that's the European domiciled collaborative body, yeah?
That's correct. So we use that framework to provide an internal net zero alignment. We also have data providers that also provide input to that process and just overall portfolio metrics. And then in addition to that, we've set portfolio level targets for the alignment ranks. And what they do is they ratchet up over time. So they increase 2030, 2040, and 2050. For example, 50% of the portfolio needs to be aligned by 2030, and that ratchets up to 100% by 2040, with, by 2050, the entire portfolio having achieved net zero alignment of a 1.5 degree.
And how does this play out in terms of decision making? You touched on the data question before. Is the lack of perfect data an enemy of good result in this case?
Again, considering we assess internally every single credit at FSI, that gives us enough information. In terms of the
Mm-hmm.
broad universe, there's more data that's required. But again, the
Mm,
global credit universe is thousands and thousands of issuers. So to be able to build a portfolio from the credits and the companies that have that data is still sufficient at this point in time.
mm,
Um, there is definitely a little bit more traction needed and time needed to continually assess those objectives and whether they are achieving the goals that they've set out.
mm.
But in a market context, it's still very much possible. And then when building a portfolio, particularly at First Sentier, where we do the work ourselves, we found it quite appealing and quite comforting. And I think that the other most important part about this is, being a bottom-up investor, you still do look at portfolio level risks. Right? It's a very
Mm.
important part to still take that into account. And that's where portfolio targets really do help. You're picking those individual names and making sure that they make sense for the portfolio. But at the portfolio level, you're saying, well, I don't want to be taking too much risk here, or I need to limit the amount of not aligned credits that I'm adding to the portfolio, for example.
Craig Morabito, First Sentier Investors. These considerations also impact on how super funds manage their risks and opportunities. Active Super's head of responsible investment, Moya Yip, explains that the $13.5 billion fund takes a systematic, evidence based approach to managing ESG risks in their internally managed portfolios and plays an integral role in how they select and monitor their external managers as well.
In the area of environmental consideration, we could, for example, be looking at how geographically diverse housing exposure is to, for example, flood and fire, and then hence levels of hazard insurance that's in place. In the area of social consideration, we look to the theme of diversity and inclusion. So we'll be looking for policy of that particular counterparty, and then measuring statistics. So the companies that we invest in, which we can look at from year to year. The other area is in modern slavery. We've integrated that into our review. And so we feel that's an important part of the review. We are looking at how managers look at that from a risk perspective, because we've always wanted to look at monitoring that. We also, from a fund perspective, have a modern slavery statement here. So we understand the process for looking at those risks. So those social aspects we are building into our integration process and looking at how our counterparties are looking at that from the environmental and the social aspect side.
Is it possible to tease out whether or not poor performance or outperformance on environmental and social factors leads to things like increased risk of default? Or are you looking at this sort of from the lens of reputational risk, i.e., as a steward of retirees' retirement
Yes,
savings or members' retirement savings, it's important to be investing in line with your policies?
absolutely. It's both of those things. So we look at the risk assessment, and as I said, we are rating our managers on a spectrum from laggard to leader. And because it's quite a large process across all different asset classes, it's different and specifically different for credit. But then we are correlating that risk assessment with return. So what you will see generally is that good risk assessment delivers long-term sustainable outperformance. Those leaders in ESG actually deliver very strong returns. We've developed that return rating over time. It's a weighted active return. And we have data sets now because we've had these managers in place for many years. It functions a lot like our empirical research. And it's very interesting. And it does, it proves that it does work over time. And that's what we feel is very important to deliver that for our members. So reputational risk is combined within that ESG risk assessment. That's a non-financial risk assessment, which is made into a quantifiable score for us.
Oh, fantastic. One of the things I love the most about this space is watching the development of what heretofore has been considered non-financial or, just qualitative, and to see how it becomes translated into actionable metrics is, it's so fascinating. So you mentioned just before that, credit behaves differently. And I know that Active Super is an active manager in terms of its stewardship obligations. Do the tools of active ownership, such as engagement, matter differently when we're coming to credit portfolios? And do you use the tools of engagement at all?
Yes, we do. So definitely it does feature. So in direct lending, evaluation of ESG can occur in the pre-investment or due diligence phase. And that could include, for example, looking at exclusionary screening, so your negative screening. Managers can, for example, develop their own ESG metrics. So for example, assessing ESG maturity of a borrower. So looking at the policies of that particular entity and then developing their own internal rating systems, just like MSCI or other ratings agencies for that particular entity. So the other interesting aspect in credit, which is different to the other areas, is covenant compliance and pricing incentives that can be built in with ESG KPIs or metrics. So a lender can, for example, set specified targets and interest rate incentives into loan documentation, such as, an increase in renewable energy use or a decrease in greenhouse gas emissions. And then these metrics, they can be measured. So that provides a basis for us and engagement over time. It's measurable. So we can look at improvement over time. There's also another manager, one of our managers deploys AI. So using artificial intelligence to pick up on ESG occurrences like, human rights abuses or cyber attacks or even fatalities in certain industries. So engagement is definitely possible. And that's how we approach it, looking for those examples when we do our ESG reviews.
Do sustainability-linked loans and sustainability-linked bonds feature into your strategies, Moya? And how do you go about establishing then that those lending covenants or those thresholds within the bonds are both stretch targets and sort of things that can be achieved?
Yeah, so we've done a big deep dive into the green bonds area. So we own all of those types of bonds, and certainly sustainability-linked bonds we have. And we've actually asked for now impact measurement within that area. We think it's very important to look at that in terms of what that bond is achieving. We want to be able to tell our members that, their money is being invested with impact. But the question now is how to measure that impact, whether that's through the lens of SDGs, which is where we started, or particular other metrics. We have also started to ask for avoided emissions. So avoided emissions or Scope 4 information, which is difficult to measure, but we think that's really important to be able to tell our members that by having these types of investments, actually you are avoiding those emissions going into the atmosphere.
So what would be, I'm curious, what's an example of an avoided emission or a Scope 4 emission?
Yeah, so for example, you may have a renewable energy asset, and you can say that you avoid it by having this particular asset that creates this energy, you avoided carbon dioxide tonnage going into the atmosphere. But it's, something very much in its infancy. It's difficult to measure. There are no standards around this, but we think it's important to ask our managers. So we've recently done a deep dive into the green bonds area, for which we hold a sleeve within the fixed income area. And we're also looking at the treatment of that within our net zero modelling and net zero emissions.
If I'm not mistaken, I think Active Super was sort of at the vanguard of investing in green bonds in the first place. That's sort of very early on.
That's correct, and we hope to do more of it as we develop the methodology for its treatment within our net zero modelling.
Now, that very neatly brings me into my next question, Moya, because earlier this year, you briefed me on some very significant net zero work you'd done over your entire fixed income portfolio. And I was very respectful of the level of transparency and discussion that you brought to this review. How does Active Super think about its net zero activities in its fixed income and credit portfolios? And can you walk us through a little bit of that process of that deep dive?
Yeah, so lenders definitely take into account ESG considerations in their investment decision making and their deal documentation, but that one step further is driving ESG improvement. So we've focused very much on climate risk since 2009. We've put restrictions in place since 2014, And then we made that commitment to being net zero by at least 2050. And so at Active Super, it's a priority for us in building this net zero model. And so hence we have started to build that net zero question into our engagement with all of our fund managers and for our investment. It's certainly different within each asset class. And if we were going to speak specifically to this credit sleeve, the engagement, has started and it's in its infancy. It's difficult, but it's certainly something that we want to put on the radar of all of our fund managers to be looking at the net zero commitment, because of course, the faster they get to net zero, the faster we get to net zero. So it's very much in its infancy. The measurement and collection of information is difficult, but we think it's really important that we ask the question. And some fund managers are advanced in this space and are measuring the emissions and doing the work and disclosing accordingly. That sort of brings about behavioural change. Once we ask for it and we can measure it, that's going to change. It's certainly very different in a credit space. In the fixed income space, of course, that's about methodology as well, and something that we're continuing to evolve. We've certainly, looked at the latest research, and we continue to stay abreast of the most current research to, build out that methodology. That's in place for equities, it's in place for fixed income. It's evolving in fixed income, certainly, for example, in green bonds, there's methodology that we're developing there. And hence the requirement to do a deep dive into what fund managers can provide in terms of impact and emissions and avoided emissions going forward. So there's certainly a lot more work to do in net zero.
You've been listening to Craig Morabito and Moya Yip. We hope you enjoyed today's discussion, which was brought to you by First Sentier Investors. Thanks for listening to the Greener Way podcast. If you liked today's show, remember to rate and review us on your podcast platform and make sure you're subscribed so you don't miss an episode. I'm Rachel Allen Backus.
The Greener Way podcast is a product of FS Sustainability, a show about people, the planet, and investing in our collective future. All information in this podcast is for education and entertainment purposes only. The Greener Way podcast gives listeners access to information and educational content provided by discussing numerous financial sustainable options and our featured guests. It is not intended as a substitute for professional, legal, or tax advice. The hosts of The Greener Way are not financial professionals and are not aware of your personal financial circumstances. FS Sustainability operates under an Australian Financial Service License and the exemption made available under the Corporations Act 2001 in respect to any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.